Sage here for Kalkinemedia. Please subscribe to the channel and press the bell icon to be notified of the latest videos. Thank you for joining us on our educational series. Today's topic is what is arbitrage? Arbitrage is a strategy that is used for exploiting the market inefficiencies for making profits. And the strategy generates income by identifying a difference between the ask and the bid prices of similar or identical assets. It is a well-documented strategy that is used by all kinds of investors, from new investors to fund managers. It is based on the concept of buying at low prices and selling at higher prices. And generally, an arbitrage involves buying the asset from one market at lower prices and selling the same asset in another market at higher prices, or selling in the same market but at a different time. And the difference between the selling and the buying price is the profit made by the trader. So what is index arbitrage? Index arbitrage is a type of arbitrage trading that involves making a profit by locating a difference between the actual price and the predicted price of the stock. The trader makes a profit by exploiting the inefficiencies in the market. The index arbitrage needs to be conducted in a very short span of time, as price difference generally occurs because the relevant information is not reflected in the stock prices. Fewer traders refer to the index arbitrage as basic trading. It is mostly used in conjunction with the day trading strategy to identify the market inefficiencies. Program trading techniques are utilised by the traders, which analyse the indexes along with the future contracts. In summary, arbitrage is a strategy that is used for exploiting the market inefficiencies for making profits. Index arbitrage is a type of arbitrage trading that involves making a profit by locating a difference between the actual price and the predicted price of the stock. And the trader makes a profit by exploiting the inefficiencies in the market. The index arbitrage needs to be conducted in a very short span of time, as price difference generally occurs because the relevant information is not reflected in the stock prices. Few traders refer to this index arbitrage as basic trading. Frequently asked questions. What challenges are associated with index arbitrage? The arbitrage strategy seems very attractive to the retail investor as it promises easy money. However, the risk and reward balance should not be avoided. It is difficult to generate earnings from the index arbitrage, especially for the retail and individual investors, because of the following reasons. The window to execute arbitrage is small. The arbitrage trading must be executed in a very short span of time. It will be difficult to execute a trade when someone is not utilising software and working manually. The price at which someone wants to sell changes in no time, and the opportunity can be lost, and moreover, the trader can incur huge losses. As the trading volume is high, the loss can intensify. And while trading through arbitrage, the time to think and execute the trade is very low, so actions should be taken quickly or through software. Next, technology is needed. Through program trading, the arbitrage opportunities can be located, and a trader can take advantage of the difference in the current and the future prices. For beginners, it is a difficult task to make accurate predictions manually, and series of calculations are undertaken by the statistical arbitragers to locate the opportunity. Therefore, the traders who cannot commit a lot of time to make a prediction should employ trading software. The transaction cost is high. The arbitrage strategy involves simultaneous selling and buying of the stocks, and therefore the transaction cost is generally high. A transaction fee has to be paid for every single transaction there is. The fee has to be paid for buying the security, and also the transaction cost also depended upon the brokers. In many cases, the traders must restrict their arbitrage to a specific amount of shares because the transaction cost is higher than the profits. So what is the role of arbitrage in the market? The function of the market is to bring the sellers and the buyers to a single place and set the prices. This process is termed price discovery. It might look like that that arbitrage is conducted to exploit the market inefficiencies. But in reality, it helps the market to keep the prices in line. To illustrate, a future contract becomes overvalued as a piece of new information entered into the market and the traders overplay it. The arbitragers identify the overvalued future contract and start selling the same to make a profit. As a result, the price of the future contracts is brought back to its original value. How arbitrage can be conducted in the market. The arbitrage activity can be conducted in the options contracts to earn a profit in two situations. Beginning with when a discrepancy is observed in the put and call parity. If the concept of put-call parity is violated, then it gives an arbitrage opportunity to the investors. To illustrate, consider the scenario of an investor taking a long position in the future contract, and in the put option, a call option is available for $20 and the put option on the same asset is available for $16. The difference of $4 is the cost of margin, which an investor has to pay for taking a long position in the future contract. Here, there is no arbitrage opportunity. However, the arbitrage opportunity can arise when the upside of the asset is seen as limited by the market participants. As a result, the cost of the call will come down from $20 to $14. The underprices call option can be bought and the future and put option can be sold. Second, strike arbitrage. When two options with different strike prices on the same underlying asset are available, then the strike arbitrage can be conducted. The differences in the prices do not last for long because of the arbitragers. To illustrate this, the company's share present value is $51 and its call option of $50 is trading at $1.50. Simultaneously, its $52 call option is trading at $3, since the extrinsic value is exceeding the strike prices. Hence, a strike arbitrage is possible. I hope you enjoyed that and found it informative. Thanks for joining us on The Report, and please like, share and comment on the video below and subscribe to the YouTube channel. Press the bell icon to be notified of the latest videos, and for more information and regular updates, please head to our website kalkinemedia.com. Sage here for Kalkinemedia.